Chapter 11, Insurance, Part 2. So in this lesson, we're going to look at car insurance. So you're all aware about car insurance, so we're just going to look at the different types. So it is required by law a minimum of third-party car insurance. Comprehensive is not necessary, but third-party to cover the third person, I suppose, or the other person involved in the accident. So the different types, we could get fully comprehensive insurance, which is obviously going to cost more and it'll cover more. So normally what third party would cover is just if you get into a car accident and you're at fault, it'll be the other person who'll be able to claim from your insurance, but you don't get anything in that your car, you won't get a new car or any, especially if you're at fault, any injuries paid for. But if you have fully comprehensive insurance and there's no one else involved in a car crash, for instance, if you just scratch it off a wall or, there's no other person involved, you can claim for your car if it's written off to get a new car, okay? Also if it's stolen or damaged by fire. So everything's covered, fire, theft, all the same. You also get things like windscreen cover. It's a lot more comprehensive, right, but more expensive. Third party, as it suggests, is just for the other person. And if you wanted to add a fire and theft insurance, you'd have to pay a little bit more as well. All right, but a lot of insurance companies just offer that all together. Okay, so moving on there. Another type of insurance would be personal injury insurance. So personal insurance provides cover for the insured person in the event they become ill or suffer an injury. So especially if, I suppose, you have your own business and, if you become ill, you won't be able to work, okay? So it's very important to have some kind of personal injury insurance in place. So you can have health insurance, which covers your hospital bills. VHI, or voluntary health insurance, is one that's well known, but there are other providers. Okay, so just to be aware that that's private health insurance. Public, everybody gets, and then some people pay into their own. Private one, just the biggest thing really, I suppose, is to get seen to quicker in hospitals, not to be waiting on a list, and maybe just to get a private room or in a private hospital. So income protection insurance then provides replacement income if the insured person is unable to work due to bad health. And that's important as well, as I said, that also covers your income if you have to pay for a mortgage. So if you're at work, you still have to pay your bills. Loan repayment insurance, so covers any outstanding loans. So that's similar to your mortgage, okay, like I was saying there. So you can get different types and different amounts of money would have to be paid on them, and obviously they want to cost more the more cover you get. All right, you can get serious illness insurance to pay out lump sum in the event that the policyholder is diagnosed with a serious illness or a disability. So there's plenty of other personal, it's all about the person insurance on them. Okay, personal accident insurance pays a lump sum in the event of the injury, disability or death caused by an accident. So just to be aware of the different types. So illness, accident, okay, having to pay back any loans, income, so you get your full income or a certain percentage of it anyway, and health then if you have to go into hospital. So personal insurance, there's all different types. I can see them there, there's about 5 of them there, okay? But it depends on the person and what they need protected and how much they're willing to pay for their policy. Okay, so also if you were to travel abroad, you would have travel insurance. So if you were out of the country, if you lost your luggage, your flights were delayed or cancelled, you lost your money or passport, you become ill or sick. So again, different levels of cover, it would cost more depending on what you have. Another one is a tax, believe it or not. It's pay-related social insurance, PRSI. So every employee pays this, and an employer also pays a percentage on every employee. So what happens is if you become ill or sick or can't work or on maternity leave, you get a benefit. So it is a social welfare payment, and that's why everyone's entitled to it. And also when you retire, you get your pension. Okay, so that tax pays for all that. Okay, principles of insurance are important now, so you need to remember the 5 of them. So these are rules. In other words, to get insurance and to be able to get compensation, you have to follow these rules. So you have to have an insurable interest in the item that you're insuring. In other words, you have to have an interest, so you have to suffer from its loss and gain from its existence, or gain from its existence, suffer from its loss. Okay, so you cannot insure your neighbour's house, for instance, okay, or neighbour's car, because you don't suffer from the loss of it. Indemnity, okay, is another principle that we'll talk about later on, but this is important at the start. Utmost good faith, to tell the truth. Okay, so if you don't tell the truth, then you will not get compensation. So you know, if you say, for instance, you keep your car in a garage and you don't, you have it parked at the side of the road and it gets stolen, then obviously you're not going to get compensation. Okay, so indemnity just means that you cannot profit from insurance. So if you have two insurance companies, you can't profit from it, or if you over-insure your over or under-insure an item, again, you'll only get the sale value of it. Subrogation then, so you're talking about the insurance company becoming the sub, in other words, becomes the legal owner of the car, for instance, and can go then and sue the other person for compensation. So they give you the money first, and then they go get it off the other third party. I suppose it makes it quicker for you. Contribution then, as the word suggests, if you are insured twice, okay, and that can happen if you maybe have house insurance and then you have insurance on, I don't know, a wedding ring maybe, but you also have it insured under the house and you lose it, then you can't claim double amount, because remember, you can't profit from insurance, indemnity. So contribution just means that both insurance companies will pay half. Okay, and we look at calculating the premiums the next day. So we'll leave that for now, and if you could just take down notes, and we'll finish this chapter in the next lesson.